Investing your first $1,000 wisely. Welcome to our channel. Today, we're diving into an exciting topic: how to invest your first $1,000 wisely. If you're a beginner looking to grow your wealth, you're in the right place. In this video, we'll explore various investment options, from stocks and bonds to mutual funds and ETFs, helping you understand what might work best for your financial goals. We'll break down each option in simple terms, so you don't need to be a finance expert to follow along. Plus, we'll share tips on how to assess your risk tolerance and the importance of diversification in your investment strategy. Making informed investment decisions is crucial, especially when you're starting with your hard-earned money. The choices you make today can set the foundation for your financial future. So, whether you're looking to save for a big purchase, retirement, or simply to grow your wealth, stick around as we guide you through the essentials of investing your first $1,000 wisely. Understanding your financial goals. Identifying your financial objectives before investing. Before you dive into the world of investing, it's essential to understand your financial goals. Start by defining your short-term and long-term objectives. Short-term goals might include saving for a vacation or a new gadget, while long-term goals could be building a retirement fund or saving for a home. Aligning your investments with these personal goals is crucial. For instance, if you're saving for a short-term goal, you might want to consider safer, more liquid options like high-yield savings accounts or short-term bonds. On the other hand, for long-term goals, you might explore stocks or mutual funds that have the potential for higher returns over time. To create a clear investment strategy, we recommend writing down your goals. This not only helps you visualize what you want to achieve but also keeps you accountable. By having a written plan, you can make informed decisions that align with your financial aspirations, ensuring that every dollar you invest is working towards your future success. Emergency fund first. The importance of having an emergency fund. Before you start investing, it's crucial to prioritize building an emergency fund. Aim to set aside 3 to 6 months' worth of living expenses. This financial cushion acts as a safety net, providing you with peace of mind in case of unexpected events like job loss, medical emergencies, or urgent home repairs. Having an emergency fund not only offers financial security but also allows you to invest with confidence. When you know you have funds to fall back on, you can make investment decisions without the stress of needing immediate returns. This can lead to more thoughtful, long-term strategies rather than reactive choices driven by financial pressure. So, before you dive into the stock market or explore other investment opportunities, take the time to save. Start small if you need to, but focus on building that emergency fund first. By doing so, you'll create a solid foundation for your financial future, allowing you to invest wisely and with less worry. Remember, a secure financial base is key to successful investing. Research investment options. Exploring various investment opportunities. When it comes to investing your first $1,000, it's essential to explore the different options available to you. Let's start with stocks. Investing in stocks means buying shares of a company, which can offer high returns but also comes with higher risk due to market volatility. Next, we have bonds. Bonds are essentially loans you give to governments or corporations, and they tend to be more stable than stocks, offering lower returns but less risk. Then there are mutual funds, which pool money from multiple investors to buy a diversified portfolio of stocks and bonds. This option provides built-in diversification but often comes with management fees. Lastly, consider exchange-traded funds, ETFs. Similar to mutual funds, ETFs offer diversification but trade like stocks on an exchange, making them more flexible. Each investment type has its own risk and return profile, so it's crucial to research and understand them thoroughly. Take your time to learn about these options, as informed decisions will help you align your investments with your financial goals. Consider low-cost index funds. The benefits of investing wisely. When starting your investment journey, low-cost index funds are an excellent option to consider. One of the biggest advantages of index funds is their ability to provide diversification at a low cost. By investing in an index fund, you're essentially buying a small piece of many different companies, which helps spread out your risk. This means that if one stock underperforms, others in the fund can help balance it out. Historically, index funds have outperformed many actively managed funds over the long term. While active managers try to beat the market by picking individual stocks, studies show that they often fail to do so consistently, especially after accounting for fees. Index funds, on the other hand, simply aim to match the market's performance, which can lead to better returns for investors over time. For beginners, index funds are a user-friendly option. They require less research and management, allowing you to invest with confidence while focusing on your long-term financial goals. So, if you're looking for a smart, cost-effective way to start investing, low-cost index funds are definitely worth considering. Utilize robo-advisors, embracing automated investing for beginners. If you're looking for a hands-off approach to investing, robo-advisors might be the perfect solution for you. These automated platforms use algorithms to create personalized investment portfolios based on your financial goals, risk tolerance, and time horizon. By answering a few simple questions, you can receive a tailored investment strategy that aligns with your unique needs. One of the standout benefits of robo-advisors is their low fees. Unlike traditional financial advisors who may charge hefty commissions, robo-advisors typically have lower management fees, making investing more accessible for beginners. This means more of your money goes directly into your investments rather than paying for advisory services. Additionally, robo-advisors are incredibly user-friendly. Most platforms, like Betterment or Wealthfront, offer intuitive interfaces that make it easy to track your investments and adjust your goals as needed. So, if you're new to investing and want a straightforward, cost-effective way to grow your wealth, consider exploring robo-advisors. They can help you get started on your investment journey with minimal hassle. Invest in yourself, the value of personal development as an investment. When thinking about investing, don't overlook the importance of investing in yourself. Personal development can be one of the most rewarding investments you make. Consider enrolling in online courses or obtaining certifications that enhance your skills and knowledge in your field. Platforms like Coursera, Udemy, and LinkedIn Learning offer a wide range of courses that can help you stay competitive in today's job market. Investing in education not only boosts your skill set but can also lead to higher income potential. Studies show that individuals with advanced skills or certifications often command higher salaries and have better job opportunities. By enhancing your qualifications, you're not just investing in your current role, you're paving the way for future career advancements. So, as you prioritize your financial investments, remember to allocate time and resources for self-improvement. Balancing personal development with financial growth can create a powerful synergy, ultimately leading to a more fulfilling and prosperous life. Start today, your future self will thank you. Monitor and adjust your portfolio. The importance of regularly reviewing investments. Once you've started investing, it's crucial to monitor and adjust your portfolio regularly. Tracking your investment performance periodically allows you to see how well your assets are doing and whether they align with your financial goals. This practice helps you stay on top of your investments and make informed decisions. As your life circumstances and financial objectives change, so should your investment strategy. Rebalancing your portfolio is essential to ensure that it reflects your current goals and risk tolerance. For example, if you're nearing retirement, you might want to shift towards more conservative investments to protect your savings. Additionally, staying informed about market trends is vital. Economic shifts, interest rate changes, and global events can all impact your investments. By keeping an eye on these factors, you can make timely adjustments to your portfolio, maximizing your potential for growth while minimizing risks. In summary, regularly reviewing and adjusting your portfolio is key to successful investing. It empowers you to stay aligned with your goals and adapt to the ever-changing financial landscape. Key takeaways for your investment journey. Let's summarize the key points we've discussed. First and foremost, setting clear financial goals is essential for guiding your investment decisions. Whether you're aiming for short-term savings or long-term wealth, knowing what you want to achieve will help you stay focused. Additionally, having an emergency fund is crucial. It provides financial security and peace of mind, allowing you to invest without stress. We also explored various investment options, from stocks and bonds to low-cost index funds and robo-advisors. Each option has its own benefits and risks, so it's important to research and choose wisely based on your goals and risk tolerance. Remember, investing is a journey, and making informed decisions is key to growing your wealth. If you found this video helpful, Please subscribe to our channel, like this video, and share it with friends who might benefit from these financial tips. Together, let's take the next steps toward a more secure financial future.